All right, everyone, let's dive into a standard that can feel like a minefield in exams, but trust me, it's also a gold mine for easy marks if you know the rules. We're talking about AS25 Interim Financial Reporting. Let's get right to it.
So imagine this. You're in the exam hall and you get this question. A company goes big on advertising in the first quarter, spending a whopping 10 crores. But their sales really only take off in the third quarter because of, say, the festive season. So management thinks, hey, let's just push that Q1 ad expense to Q3 to make the profit and loss look better. The question is, can they do that?
If you're thinking, maybe, then you've just walked right into a classic exam trap set by ICAI. And that's exactly what AS25 is designed to stop. So today we're going to break down every single rule, piece by piece, so you can spot these traps a mile away and answer with total confidence. Okay, so Section 1, why do we even need AS25? Well, think about it. Without these rules, companies could just play around with their quarterly numbers, shifting expenses and pulling revenues forward to make their performance look way smoother than it really is. AS25 exists to make sure investors get timely and reliable information, not a fantasy story. Now, here's a crucial point right at the start. AS25 does not say every company must publish quarterly or half-yearly reports. It's not about that. It just says that if you are required to, or if you choose to, then you've got to follow these rules. And that report can be either a full-blown, complete set of financials or a shorter, condensed version. Let's move on to Section 2. This is all about presentation, and let me tell you, ICAI absolutely loves asking theory questions on disclosures and what needs to be shown, so pay close attention here. This is where you can pick up some easy marks. So a company has a choice to make. It can go all out and present a complete set of financial statements. We're talking the whole shebang, just like the annual report. Or it can provide a condensed set. This is the minimum you can get away with. You still have the main headings and subheadings from your last annual report, but the notes are selective. The whole point is to focus on what's new, what's changed, and not just repeat everything from the last big report. So what does selected mean? It means this list right here. You should definitely be familiar with these points, because like I said, this is prime territory for theory questions. The common theme here is change. Have your accounting policies changed? Have your estimates changed? Did you merge with another company? If it's something significant that's happened since the last annual report, you got to disclose it. Okay, everyone, listen up. This table is where so many marks are needlessly lost. It's so important. For your profit and loss and cash flow, it's pretty intuitive. You compare this quarter with the same quarter last year. Simple. But look at the balance sheet. This is the trap. You do not compare it to the balance sheet from the same quarter last year. You compare it to the balance sheet from the end of the last full financial year. Please remember that. It's a huge exam point. All right, let's get under the hood now. Section 3 is all about how we actually calculate the numbers. These are the measurement principles. This is where we're going to find the definitive answer to that ad spend question we started with. This quote right here is the golden rule of AS25. If you remember one thing, remember this. Reporting quarterly doesn't give you a license to do things differently. An interim report is just one piece of the bigger annual puzzle. Everything you do has to be consistent so that when you add up all the quarters, you get the correct annual result. And that golden rule leads directly to these core principles. You have to use the exact same accounting policies as your annual statements. You measure things on a year-to-date basis. And here it is, the big one. An expense is recognized when a liability is incurred. Income is recognized when an asset is created. You absolutely cannot defer costs just to smooth out your profits. That's a huge no-no.
Here's another little twist ICI likes to throw in, materiality. So, let's say a 50 lakh expense might seem like nothing compared to a company's expected annual turnover of 500 crores. But what if in Q1, the turnover was only 5 crores? Suddenly, that 50 lakh expense is a very big deal, right? So the rule is you judge materiality based on the interim numbers themselves, not some future annual forecast.
Tax calculation also gets a special treatment. You don't just take your quarterly profit and apply the standard tax rates. No. What you have to do is estimate your total income for the entire year and figure out the weighted average annual tax rate you expect to pay. You then apply that one single rate to your interim profit. This keeps things consistent across all the quarters, and it's exactly the method you'd use for a problem like illustration 2. Okay, now for the really practical stuff. What happens with businesses that have busy seasons and slow seasons? You know, their income and costs are all over the place during the year. Let's see how we handle these seasonal and uneven items.
When it comes to revenue, the rule is super simple and super strict. If you sell umbrellas, you recognize the revenue when you sell them in the monsoon season. You don't get to book some of that expected profit back in the dry summer months. If you get a big dividend payment in Q1, you book it all in Q1. You don't spread it out. Revenue is recognized when it happens. Full stop.
So revenue is a closed case. But what about costs? We already know we can't just defer things to make the P&L look good. But are there any situations, any at all, where it might be okay to anticipate or defer a cost? Well, yes, but it's very rare, and it has to pass this really tough two-step test. Step 1. Ask yourself, for this type of cost, would it be okay to defer or anticipate it at the end of the year? Think of something like a massive planned factory shutdown for maintenance that happens once every few years. Step 2. Is this cost actually being incurred unevenly? You have to get a yes for both of these questions. If you don't, then you can't touch it. All right, theory's done. Let's put this into practice. This is where we connect all the dots and see how these rules come to life in the kind of problems you're going to get in your exam.
So let's take a look at illustration 1. We have Sincere Corporation, and you can see right away this is a seasonal business. They make almost nothing in the first half of the year, and then bam, 60% of their entire year's sales happen in Q3 alone. Now, the company in the problem wanted to take 10 crores of its regular, everyday expenses from Q1 and just shift them over to Q3 to match up with those high sales. Based on everything we've just learned, can they do that? Of course not. Those are routine costs incurred in Q1. They have to be recognized in Q1. The attempt to defer them is a clear violation of AS25. The correct profit is 8 crores, not the inflated number the company wanted to show.
Now pay attention to this, because this is a very subtle point that ICAI loves to test. There's a difference between a formal interim financial report under AS25 and the quarterly interim financial results that listed companies often publish. For a full-blown report, every single rule of AS25 applies. But for just the results, only the recognition and measurement principles apply. The detailed presentation and disclosure rules don't. Knowing this difference can save you in an exam. And one last special case for you. What if there's a big change in an accounting estimate, like a warranty provision, and it happens in Q4? If the company doesn't publish a separate Q4 report, does that info just disappear? Nope. The standard is clear. You have to disclose the nature and amount of that change in a note to the annual financial statements for that year. So, let's do a final, rapid-fire checklist for the exam. Number 1, recognize income and expenses when they occur. No smoothing. 2, materiality is based on the interim period's numbers, not the whole year. 3, tax is calculated using that special estimated annual effective rate. 4, the presentation rules, especially that crazy comparative table, are just as important as the calculations.